Hello, everybody. John Clay here. And you're probably asking yourself, what in the world is going on in the stock market these days? Well, stay tuned, and I hope to give you not only an explanation of what is happening, but some of the concepts behind how what is happening is actually happening. So stay tuned. So, what is happening in the stock market right now? As I record this, the information that I'm using is current as of Saturday, January 30th, 2021. This is an unfolding story here, so I may do updates. I'm going to keep on top of what's happening, and then if I see a need for additional videos, I'll go ahead and make those available to you. Let's get into the actual teaching part and see if I can shed some light on what's happening right now. This is a video workshop, and it's called the Reddit Revolution. I didn't come up with that term myself. In some of the things I was reading, I think it was USA Today. No, I forget what I was reading, but they coined this term, and I'm just kind of going with it right now. For those of you that don't know, my name is John Clay, and I'm a longtime teacher, a longtime individual investor, and a longtime educator about the stock markets. So according to a January 29th, 2021 report in the USA Today, that was Friday, there is a Reddit revolution. Furious Reddit users decided to strike back against the big hedge funds by launching a buying spree of GameStop stock. That's kind of hard to say after a while, which caused the price to soar. Suddenly, a movement was born. And not to be outdone, on Saturday, January 30th, the Wall Street Journal started their report by saying, "This was the week when a bunch of amateur traders made Wall Street's finest look like idiots." And as I record this, that's pretty true right now. So what in the world is happening? Well, what do we do when there are things going on in our world that we just don't quite understand? Like most Americans, and even people in different parts of the world, it's common to turn to the White House when things need to be explained in a way that can make us all feel better. Okay? So there's a lot of confidence there. This will undoubtedly make things more clear. So let's see what they had to say.
Is the White House concerned about the stock market activity we're seeing around GameStop, and now with some other stocks as well, including the subsidiary or whatever, the company that was Blockbuster? And have there been any conversations with the SEC about how to proceed?
Well, I'm also happy to repeat that we have the first female Treasury Secretary and a team that's surrounding her, and often questions about market we'll send to them. But our team is, of course, our economic team, including Secretary Yellen and others, are monitoring the situation. It's a good reminder, though, that the stock market isn't the only measure of the health of our economy. It doesn't reflect how working and middle-class families are doing. As you all know from covering this, we're in the midst of a K-shaped recovery. America's workers are struggling to make ends meet, which is why the president has introduced this urgent package to get immediate relief to families.
Okay. I feel much better now. Don't you? Yeah, let's see what Krusty the Clown has to say.
What the hell is that?
Exactly. They don't have an idea what's going on. But don't worry, there's a woman in charge. Now, personally, I don't care. Whoever is ahead of the Treasury right now, whether it's one of the 20 or 30 different genders that are available, doesn't matter to me. Why is the answer the way she answered it there? Okay, they're on top of it. They're monitoring things. That means they don't know what's going on. And so it's going to be up to us to look into this a little deeper and try to figure out what is happening here. Yes, I am worried when I listen to reports like that. Yes, some of you remember the old Alfred E. Newman from Mad Magazine. But don't worry, Janet Yellen is here. Now, she was the chairperson of the Fed for a number of years. She was appointed under President Obama, and then shortly after President Trump took office, she stepped down, and we now have a new Fed chairman. Well, she has now become part of the Biden administration as the Treasury Secretary. So don't be afraid. Don't be afraid. She doesn't look afraid in this picture. Yeah. Okay. But we also have to ask ourselves, WWBD. Remember when that was popular with WWJD? Well, what would Bernie do? Uh-oh. Bernie's a little busy right now. Okay? So I don't really know what he would say about anything at this point. So we can't really look to him for any answers. So basically what is happening is the media, whether it's the mainstream media, CNN, MSNBC, Fox, they have no clue what's going on right now. They're just like the press secretary. Don't be afraid. There's a woman in charge. Okay, and we're monitoring things. And I'll just go read what the SEC wrote in their release. Okay, that really helps me feel a lot better. Then you even turn on the financial channels, and all they do, folks, they just read what's put in front of them. They don't know what's going on. They just can read well, and they look good on camera. They're eye candy. Now, there are exceptions. There are some people who really do understand what they're doing and are eye candy at the same time, but they're few and far between. So we need to take it on ourselves to really understand this whole thing a lot better. In defense of the obviously uneducated media, and remember, they call themselves the elites. They're supposed to be able to tell us what to do, what to think, who to vote for, whether we can go to church, synagogue, or the mosque. They've got it all under control. So they have all the answers. I don't see many answers coming from them right now. We need to find those answers ourselves. But in their defense, what is happening is rather complicated. If this is new to you, you probably won't understand what's going on. That's why they can't explain it to you on TV. They just come up with their little talking points. They say those and go, I have no idea what I just said. Don't ask me any questions. Okay? It does take a little bit more of an effort to learn what's happening. And it'll take some more in-depth information to explain. So I'm going to try to do some teaching here and actually show you not only what's happening, but the concepts behind what is happening. So there are some very good explanations. I found some good podcasts and articles and different things, YouTube videos even, that I found that did a pretty good job of explaining this. And at the same time, I found some really bad ones that really had no idea what they were talking about. So to help understand the current situation, it's necessary to define two concepts. So you're going to have to hang with me for a little while on this as I explain these concepts. Until you understand these concepts, it's going to be hard to understand really what's happening right now. This first one is called the bid-ask price. Now, I haven't heard in all of the things that I've been reading and listening to and watching, I haven't heard anybody talk about this. It doesn't mean there hasn't been anyone talking about it. I just haven't heard them talking about it. So I'm going to go through and explain a thing called the bid-ask price, because that plays a real big part in this. And then secondly, a concept called short selling, which again, most people don't necessarily understand. And so I'm going to go through, give an example, different examples, and my hope is by the time you're done watching this, you'll have a really good understanding of both. But then we also have to talk about something else. It's necessary to explain what's a hedge fund. We're hearing these terms, short selling, hedge funds, all these different things are being flying around all these days, short squeeze, blah, blah, blah. And the media just throws it at you because they don't understand it. So they just tell you the word. They don't actually explain what's going on behind the word. All right. So first of all, let's get into this a little bit and try to understand what is the bid-ask price. Now, at any given time, let's say you own a stock or you want to own a stock, either way. At any given time, if you were to just stop everything and freeze it, like use the pause button on your remote, you would notice that there are two prices for a stock at any given time. One is called the ask or offer price. I don't use the word offer in my slides, but I just refer to it as the ask price. Now, if you were looking to go into the stock market and you want to buy a stock, this is the price you're going to pay if you buy it. You don't own any of it right now. You take some money and you go into the stock market and you want to buy it. You're going to buy at whatever the ask price is at that moment. Now, if you want to sell, okay, you're going to sell at what is called the bid price. I just remember it, bid, sell, BS, okay? The learning by association or remembering things that way seems to help me pretty well. BS, buy, sell. The price an investor will receive when you want to sell. And so there are two prices, a buy price and a sell price. Each stock is different in the stock market. Microsoft stock and Cisco stock and Google stock and Apple, they act differently than other stocks like GameStop or Bed Bath & Beyond or some of the airline stocks. These are the stocks that are kind of in the news, but GameStop is really getting most of the press. So again, each stock is different, but the more volume on that stock, the closer these two prices are likely to be to each other. That's what we as an investor wants. We want the bid price to be really close to the ask price. Some stocks that are not traded very heavily, that don't have a lot of volume, the prices could be very different from each other. And I'm going to go through and explain that a little bit here. So for example, let's say you have two stocks that you're looking at. And one is stock A, very inventive name I came up with there. And then you have stock B. Now, somebody used to use XYZ company in all their examples in the books I used to read, but then I think a company actually came up with that name. And I think there's an ABC company. So I just go with stock A and stock B. Okay, on the stock A, about 10,000 shares trade every day. Now, is that a lot or is that not very much? Well, you have to know, and you have to measure it compared to other stocks in the market to see if that's a low amount or a high amount. Where stock B, they trade 10 million shares a day. So that has a lot more interest. So on stock B, the bid-ask price will probably be a lot closer to each other than in stock A. You might have what's called a larger bid-ask spread. So for example, they're both at $10 a share, okay? And you like them both, and you want to invest in both of them. So let's look at their bid-ask prices. If you wanted to go in and buy, you are going to pay $10.05 per share. That's to buy. Let's say that, you made a mistake, and you immediately, that same instant, a microsecond later, you decide you want to sell and the bid-ask price has not changed, you could then sell it for $10 per share. So you see a little bit of a difference there? You're going to pay 5 cents per share more to buy at that moment than you would get if you sold for $10 a share. So we take those two, here's the ask, here's the bid, and we say that the bid-ask spread is then 5 cents. Now, you might be okay with that, but you might not be okay with that because there are some stocks out there that have really wide bid-ask spreads, and you're going to get a lot less than maybe even the last traded price. So let's look over at stock B. It's also $10 a share when you're looking at it, and you see that, I can buy this right now for $10.01. And if I wanted to immediately sell that, I made a mistake or I had buyer's remorse or something, I could immediately sell that for $10 per share. So the bid-ask spread on that is 1 cent. That's a lot closer. And this is a very big part of what happens in the market, and a big part of some of the concepts that I teach is dealing with the bid-ask spread. But I don't hear anybody talking about that right now because it plays a really key role in what's happening. So here's just an example. You can see at the very top in yellow, there's a bid of 2081.25 and an ask of 2081.50. You just subtract the ask from the bid, the bid from the ask, and you get a 25-cent bid-ask spread. Now, if you look down through these numbers, you'll notice, on the second one, there's a 75-cent spread, and then it gets all crazy as you go further down this list. And this is what I watch, and this is what other investors watch. When they're looking to get in, they're watching the ask price. When they're looking to get out, they're watching the bid price. It might be different than what you see scrolling across the bottom. Or you might have software like I use where if the last price was at the ask, it comes up green. Poof. If the last time that stock traded was a sell, it comes up red. Doesn't mean it's gone negative. It just means that was a sale, not a purchase at that point. Okay, let's see the bid-ask price in action, or I should have said prices right there because there's two, so it should be plural. So anytime the markets are open, usually Monday through Friday, if you live on the East Coast, it opens at 9:30 a.m. If you live on the West Coast, that's 6:30 a.m. If you live in another country, it could be tomorrow. I don't know. So it'll just depend on where you're at in your particular time when the markets open or close. But these bid-ask prices, they change all the time, even several times within a minute. You get a stock like Microsoft, Google, or some of the heavily traded stocks, they're flying all around. That thing can trade 100 or change 100 times in 1 minute. It's going up and down, up and down, up and down all the time. So these changes can even occur if nobody buys or sells the stock at that time. You might have a stock that you've held on to for a while and it doesn't trade an awful lot. And so you're watching it, you're looking maybe to get out or maybe to buy more, and no trades are taking place, but you see the bid-ask moving up and down during the day. That still happens. It just means what they're willing to buy or sell the stock to you right now would be if somebody was to actually do that. So it can change many, many times. So if there are a lot of investors who want to buy a particular stock, the market maker, that's who they actually go to. That's the person, just to keep it really simple, they're standing there and they have, okay, 2 lines, everybody. Anybody who wants to buy is in this line. Anyone who wants to sell is in this line. And then they can see the length of each line. And so they know, I can change these prices, and let's see if those lines actually change. Okay, and I'll go through some of that. So the market maker who is selling you the stock, if they see a big long line in the buy line, they will keep raising the price. Because remember, they're selling it to you. You're buying, but they're selling it to you. So doesn't it make sense that they want to get the highest price possible? So if they see a whole lot of buyers there, they're going to keep pushing the price up. Well, eventually the price is going to go to a point where, the line's now empty. There's no more buyers. So maybe I'll keep it the same. There's still nobody in the line. Maybe I'll drop it a little bit. Nobody in line, drop it a little bit more. Now there's a few people in line. Okay, that's the new price that we will have. And just the inverse happens when you're going to sell a stock at that point. So if there are a lot of investors who want to sell a stock, the market maker who is buying the stock from you, you're selling it, they're buying, they will lower the bid price until sellers are no longer interested in selling. And a lot of times when you get the whole long line of sellers, that's kind of when you have what's called a market crash. There's a whole lot of sellers and not many buyers. And so you get everything pretty lopsided at that point. But somebody has to be on the other side of each transaction, even if it's the market maker themselves. Sometimes they do that. So when there are the same number of buyers and sellers, then things are even. If you see 5 people in the buy line and 5 people in the sell line, and they're all kind of happy with the current bid-ask price right now, the stock price will just stay the same. And some stocks do that. They might trade for a period of time at the same price. But then if you start to see this imbalance, one way or the other, of buyers or sellers, this causes the stock price to move up if there are more buyers, or to move down if there are more sellers. Remember that it's the game of these two prices right now. It's buying and selling. And folks, if you wanted a holy grail to the stock market, this is it. This is how complicated it gets. Now, it doesn't mean it's easy, but this, as far as understanding how the stock market works, in its very basics, this is it right here. There's really not a lot of additional things going on. Now, it can get more complicated, and you need experience to know how to work these things the right way. But as far as understanding the concept, this is pretty much it. You have buyers and sellers. They come together in a place called the stock exchange, which might be a physical place, or it might be over a computer. One agrees to buy, one agrees to sell. Everybody's happy. We go on to the next one. So understanding long and short. Now, this is where people have a little bit of trouble here. People can understand the concept of long pretty easy. Just remember, buy low, sell high. Not really hard to understand. I want to buy a stock at 10, sell it at 15. Woohoo! That is what we call going long. But then there's another part of this whole equation, and that's where sometimes people get the old deer in the headlights look, because it may be a little hard to understand at that point. So there are 2 types of transactions in the stock market. Buy, okay, and sell. Woo, yeah. If an investor wants to buy low and sell high, then what we do is we say that investor or trader or fund or whoever's doing the buying, they are long. So if you watch any of my videos and you say I'm net, and I say that I'm net long right now, that means that the things that I'm doing, I'm hoping will go up in value. Okay? And that one's pretty easy to understand for people. Here's where it gets a little complicated. If an investor wants to sell high and buy low, then that investor is short. And you're like, okay, how can that happen? Well, I'm going to tell you how that can happen. So putting a long together, and this, I should be able to go through this pretty quickly because it's not all that complicated, and it's what most market participants do. If you're in a mutual fund, a 401k, a Roth IRA, or some kind of a retirement plan, or if you just have your own portfolio, it's not all that hard to understand. And the markets are really geared towards it to go up. And even though we have some really bad downtimes, overall, most investors are long in the market. But let's just go through that to see how it works. So when you're long a stock, it means you want to buy low, sell high. You enter the investment by paying the current ask price. Okay. Now, it'll come up just as a price along the ticker, or you'll get a confirmation from your broker saying you bought at this price. But at the moment when you entered into that investment, your price was the ask price when you bought. So then, let's say at some point in the future, you may decide that you want to sell that stock. Okay? So when you sell, the price that you will receive is the current bid price. Again, for you, it's just, hey, yeah, I got out at 20 or I got out at 15. But as that trade was being transacted, it was, when you sold, it was done at the bid price. Here's an example. You want to buy $10, a $10 stock, and you do that on January 1st, 2021. Now, good luck doing that because the markets are closed. I'm just trying to use this as an example. And at the time, whether it's right when the market opens or at some point during the day when you enter your order, you log into your computer, you log into your brokerage account, and you say buy. You hit the button. At that moment, your trade gets sent through the system. The ask price is $10, and the bid price might be $9.95. There's a 5-point spread or 5-cent spread there. Now, let's say some point in the future, 4 years later, on January 1st, the stock is now at $20 per share. Ooh, you doubled your money in 4 years. Good for you. Okay, so on January 1st, when the market's closed, you decide that you want to sell that stock. When you go in to place that transaction, the ask price might be $20.05, where the bid price is $20, and that's the price you will receive when you go ahead and sell the stock. But congratulate yourself, you just made a 100% return. You bought a stock at 10 and sold it at 20. What could go wrong with that? Okay. So now here's where it gets a little more complicated. Understanding short selling. And I teach classes on these things, and I'm always asked this question the first time. That you buy first and sell next when you're going long, or you buy to enter when you're going long, and then you sell to exit when you're getting out. That's easy. No problem. But when I say you sell to enter, and then you buy to close, and hands go up all over the place saying, how can you sell something you don't own? And then to make things even worse, I answer a question with a question. My usual response is, well, how can you buy something when you don't have the money? Okay? We have these things called credit cards. You don't have to have all the money now. We don't have to come up with a whole price for our house right now. We just have to come up with a part of it. But we can still live there and we can still use it and then spend the next 15 to 30 years paying for it. So if you believe that you can do that, you can buy things when you don't have the money, do you think it's even possible that you can sell something when you don't own it? And usually the response I get back is, well, I don't really understand it, but yeah, I'll go with you for a few minutes on that. And then now I launch into my spiel about short selling. And believe me, folks, this can be a little hard to understand. Okay, it can be confusing and it may require an aha moment. And I'm not exaggerating. There's one time I had an 8-hour conversation with somebody trying to explain short selling to them. And they never did really understand it by the time we got done. It didn't click for them. I was using hand signals, I had puppets, I was drawing things out, and it just didn't make sense. And so you might be one of those people. I'm not trying to insult you. I'm just saying this might be new to a lot of you, and you're like, huh? I just don't get it. So I'm trying to use some real-world examples. I use some in the class that I teach where I talk about this, and I'll use, hopefully, what I think would be an easy-to-understand example here. But you're going to have that, the heavens will part and beams of light will come down and the angels will sing. There will come a time where you suddenly understand this. And then what I'm hearing most of the time about what's happening right now is they just, in very simple terms, you buy low and sell high. Well, when you go short, it's just the reverse of that. You're trying to sell high and buy low. And that might help a lot of people who've been involved in the markets for a while, but it still doesn't really explain what's going on. And that's what I'm trying to do here. So let me give you an example. You have a goal. Yeah, a lot of us have this goal. We want to make some money. There's only one problem. You don't have any money, but you still want to make some. Okay? And a lot of these, checks and what do they call it? Guaranteed monthly, that hasn't happened yet. Okay? So right now, if you want some food or if you want to pay your rent, you need to come up with a way to have some money. So you think you can make some money by selling Super Bowl tickets, okay? Maybe you're a big Chiefs fan, or maybe you don't even care. You just know that the Super Bowl is very popular and a lot of people want to go. And so you have come up with this idea to sell Super Bowl tickets to someone else. You don't really care. You're going to go play GameStop videos all that day. Okay? You're not even going to watch the game, but you see a way that you can make some money. Here's a long example. You can buy the tickets you found either through a friend or online or something by going down to and standing in line. That you can get those tickets for $800 each. Okay? And you have a friend, your friend Clem down the street. Hey man, I want to go to Super Bowl. Okay? And he's, I pay $1,000 for those tickets. Okay? So you already have somebody lined up that you want to sell those to. So you go down, and let's say when I said you don't have any money, you had $800. Okay? Or maybe you had $1,600 if you're buying 2 tickets. So you go down, you buy the tickets for $800, and then you go over to Clem's house. Hey, dude, thanks, man. And then you sell those for $1,000 each. After everything is finished, your outlay was $800. You got $1,000 from Clem. You just made a $200 profit for each ticket. So if you sold 4 tickets, that would be $800. If you sold 5, it'd be $1,000. But I'm just using the 1 ticket example because maybe you like to go to the Super Bowl alone for some reason. Now here's where I hope it will make sense to you. A short example. Remember the problem is you don't have any money? But you go over to Clem's house. He's like, yeah, man, I really want a Super Bowl ticket. And you say, well, okay, Clem, how much are you willing to pay? $1,000 per ticket. Okay? And so you tell Clem, well, Clem, why don't you give me that $1,000 and I'll go find the tickets for you. He's like, okay, man, yeah, save me from getting up off the couch. You know, oh, by the way, can you hand me the remote? All right. So what you do is you take that $1,000 from Clem and then you go to the place where you buy the tickets and they're $800. And then you take 1,000 of that, you take that $1,000, you take 800 of that, you pay for the tickets, you now have $200 left over. That is your profit. You just did a short sale. You sold something first that you didn't even have. You don't own it, but you're given the money for that. And then you go out and then you buy that for $800 and then you get to split the difference between the two. You just made some money. That is a very simple, because it is a little bit more complicated than that, but that's a simple example of a short sale where you sold first and then you bought later. And you're happy because whether you went long or short, you made $200 per ticket. But what could possibly go wrong? A lot of things. Short selling may sound great as long as everything goes the way you want it to, but what happens if things go wrong? The pain can be really extreme, and we're seeing a lot of things called hedge funds who are not sleeping this well this weekend. They're experiencing some major pain right now. Since it is true that an investor buys at the current ask price and then sells at the current bid price, I'm just trying to review that a little bit. Stocks that have a large number of short positions have traders who have done just the opposite. They didn't buy low and sell high. You have a lot of traders, and I really hesitate calling them investors because they're really not. They're just market participants. They're doing just the opposite of that. They're trying to sell high and buy low, just like the second example with the Super Bowl tickets. So short sellers sell at the bid price to enter a position. That's what you would do if you're trying to sell your stock. Well, when they open their position, they are selling a stock at the bid price. then short sellers, when they want to get out of it, they have to buy that stock at the ask price. And this is what makes things get crazy. Okay, and I'll get a little more into that here. So when a short seller starts to experience a loss, it's required to take action much quicker. Now, let's say you bought some stock, I don't know, last week, last year, last decade, last century, and for $10 a share, and let's say you put up $10,000 for 100 shares, or I guess that'd be 1,000, whatever it is. Let's say you put up $10,000. You know that that's all you can lose. If worse comes to worse, and you have to finally get rid of that stock, you know you're going to get some money back in case it goes, unless it goes to zero. That's when you won't get any money back. But that's as low as it can go. The worst you can do, and I know this is not fun, but the worst you can do is lose what you invested. Okay? Now that may sound like a real ripoff and not very much fun, but just give me a second to explain the alternative to that. So if a stock that is expected to fall starts to climb, you're a short seller, you get in thinking it's going to fall, but it starts going up. A short seller must cover or go in and buy so that they can cover or pay for any losses, and they have to exit that position. This means that they must buy to close. And when you buy, you're at the ask price. Okay, can you kind of see where I'm going with this? When a stock starts to run away to the upside, it's like, man, this thing's just going up and up and up and up. It's not that buyers are necessarily who are going long. It's not that they're just getting in there buying as quick as possible. It might be short sellers who are losing everything and they have to get out. But this produces a situation where the stock just keeps going up and up and up and up and up because they're executing their exit orders at the ask price. And this forces the shorts to cover, which you might hear this in the financial news or when I do my videos, you might hear this called a short cover rally or a short squeeze. These are a couple of terms that are floating around in the markets right now. So just be aware of those. That's what's going on. People that thought the stock was going to go down, it's not going down, so they're getting out, and that's pushing prices even higher. So let's go in and try to understand short selling a little bit better. So let's go back to our Super Bowl ticket example. I'm hoping that that's something that is easy enough to understand where you can take the concept from this example and then put it over into the stock market. So remember our short example. You don't have any money, but you can sell the tickets to Clem for $1,000 each. That money can then be used to buy the tickets for $800. You've made a profit of $200 on each ticket. Woohoo! Everybody's happy. And if Clem can get up off the couch, he'll be happy too. So what if something goes wrong? What could possibly go wrong? The people that have these short positions right now, they're the elites. They're the big money. They're the ones who supposedly manipulate the market and make things go the way they want them to go. How come they're panicking right now? Well, that's what we see being played out right now. Instead of the Super Bowl tickets costing $800, let's see, you went over to Clem's house. Before you left your house, the tickets were $800. You get the $1,000 from Clem, but then your heart sinks when you go to buy the tickets, and now they cost $1,200. Oops. Okay? You've already sold the tickets to Clem for $1,000, but now you have to buy the tickets for $1,200. You now have a loss of $200 on each ticket. So something changed in that amount of time, and things can change quickly, like what we are seeing in the stock market. But in all areas of life, things can change really fast. So what if the price then, by the time you got down there to buy the tickets, what if it went to $2,000? Okay, you brought in the $1,000 from your friend selling the tickets, and then you subtract the price that you have to pay. If they're $2,000, you have a $1,000 loss. Okay, things are not looking very good for you right now. What if you get to the place to buy the tickets and they're $3,000 each? Now, this is only if the Seattle Seahawks are in the Super Bowl because they're the best team, and naturally people would want to pay a lot of money to see that. Okay, for those of you that don't know, I'm from the Seattle area and I like the Seahawks, okay? So now you have a $2,000 loss, the $1,000 you took in, and then the $3,000 that goes out. You take the difference between the two and you have a $2,000 loss. There's really no limit. Okay, when you're long a stock, how low can it go? 0. Unless you're oil or something that actually went negative there for a while, unless your interest rates in Japan sometimes, and in Germany right now where they actually go negative. Those are weird things that are kind of beyond what I'm talking about right now. But as a stock owner, it can only go to 0. It might trade 1 cent a share, but it hasn't hit 0 yet. So that's as low as it can go. But how high can a stock go? Nobody knows. The sky's the limit. Well, there is a limit to the sky, but it could go to anything. It's whatever investors are willing to buy and sell. That's the price. So there's no limit. As long as somebody is willing to pay a price. It's like, why do these... It kind of makes me not angry, because there's a lot of other things to be angry about, but when they pay these sports stars, these athletes, all this money, they get mad at the athlete. And I'm like, why? The owner, they're the one that you should be mad at. They're willing to pay that price. If you're a good athlete and you can make really good money, why not? And they're willing to pay you $10 million a year, go for it. If the owner is willing to do it, that's the person that's really saying yes or no to the deal. It's not the athlete necessarily. So whatever the price is, that's the right price at that moment. And now prices are always changing. And so it might be the right price at this minute, but 10 minutes later, that might be the wrong price. And then the bid-ask shifts and prices trade either higher or lower just a few minutes later. But whatever the current price is, that's the right price. We have to follow price, no matter what it's doing. Even if all of our logic says something should be going up and it's really going down, doesn't matter. You have to follow price and act accordingly. So what has happened in this example is your clever idea has backfired. Maybe that wasn't such a good idea after all. Now, there's some people that really hate short sellers. Or they may, if they've even heard of short selling, they know just enough about it, kind of like in today's world where people know just enough to either really like or not like something without really understanding it. There are people that really hate short sellers. So, a few reasons why, and I just came up with this list myself. There might be even more than this. It's harder to understand. Like I said, I have to do a video about this just because there's a lot of people that don't understand it. I had an 8-hour conversation, and the person still didn't really understand what I was talking about. They did a couple days later. It took them a little bit of time, and they were rolling around in their head the things I was saying. And then they came back to me and said, I get it. Yaha, woohoo. Okay? And it might be that way with you, but a lot of people don't understand short selling. So they're just like, well, at least I understand going long, buy low, sell high. That's not all that hard. So when you are a short seller, the financial requirements are massive. When you can't do like you did with Clem, you can't take his $1,000 and run out and go do it. No, when you short stock, the money that you get has to stay in your account. And not only do you have to have that money stay in your account, you have to have a bunch extra money in your account in case things do go wrong. And a lot of this came about because of the 1987 crash, where a lot of shorts were caught and they didn't have the money in their accounts. People were losing their houses, their businesses, their cars, because that has to be repaid. And there's no, well, I can't do it right now. You can't be the federal government and just, here's too much money. Let's just create it out of nothing. Or modern monetary policy or modern monetary theory. okay? You can't do that as an individual. The government can, but you can't, okay? The financial requirements for all of the players, whether they're hedge funds, mutual funds, individual investors, the big boys, the pension plans, the 401k folks, they have to play by these rules. And if they decide to go short on something, they have to have the money behind them in case things do go wrong. Then you can lose more than your investment. You remember a minute ago I said that if you buy a stock at 10, as low as it can go is 0. Well, what's as high as it can go? Nobody knows. It could just go to infinity and beyond. Okay, I said that a little different than the movie, but still, there's no limit. That's what makes the stock market a very good enticement for a lot of people is you can buy a stock at $1 a share, and a number of years later, it could be $100 a share. There's no limit. You don't know where it's going to go. But you can, when you're short, you might invest $1,000, but you might end up losing $10,000 or $20,000 or $100,000. And it can get really nasty and really ugly really fast when you're a short seller. Now, there are some people, and I understand this, folks, the idea behind the stock market, when you take your hard-earned money, well, or some people take their money that they got in the mail from the government, and which wasn't really hard-earned, but you're still paying for it. No matter what they say, nothing's free, okay? You take some money, however you came about that, and you put it into the market betting on the future of that company. And I don't like the word bet. Wall Street can be like gambling, but if you play it right, you can remove most, if not all, of the risk. And that's what I teach people how to do. But anyway, you might think, well, these guys that are making money when something goes down, that's not very American. That's not very patriotic. We shouldn't be allowed to do that. And there are some people that feel that way. And if you do, it's okay. It's okay. So you don't feel bad about that. Or some people think that's even unethical. Oh, you shouldn't make money when other people are suffering. Well, there are market cycles. There's a time for everything. And, the birds, to everything, turn. Okay, never mind. The markets go through cycles. And there's a time for it to go up, there's a time for it to go sideways, and there's a time for it to go down. And some people think that going down part, with all these other people suffering and maybe losing their retirement or a good portion of their retirement, that's not very nice, and I don't want to be a part of that. Okay, if you feel that way and you're strongly convicted about that, I can totally respect that. But if you're also a person that realizes this is a fact of life, that there are cycles, that there's a time when the market goes up and there's a time when it goes down, and I want to be able to take advantage of both. If that's how you feel, that's fine too. It's where do you stand, and don't let the media tell you what to do. Don't let all these, think for yourself. You decide if you think this is patriotic or unpatriotic, or if this is ethical or unethical. Don't let somebody else tell you. You make up the decision yourself. You're smart. You got a brain. Use it. Okay? All right. So you may think that short sellers are the ones who drive stock markets down. Now, looking at my example, what do the short sellers have to do to get out? They have to buy. So when they go to take their profits because they have to deal with their losses, they have to buy. Now, it's true that when they entered their position, they did so at the bid price. And if a whole lot of them are doing it, yeah, that can drive things down. But to think that something continues to go down and is in a free fall, and it's the short sellers that are causing it, that just means somebody doesn't really understand what's going on that uses that example. It's usually the people that don't know what's going on. They're the panicked ones, right? At that point, they're the ones going in and selling and driving everything even lower. So be careful if you use that as an argument. It doesn't mean it's not true. It just means it's not necessarily the whole story of what's going on. So if you've ever heard this cliche that we use, don't sell yourself short, you probably use it all the time. We get that from this. When you short sell the market, that means when you sell yourself short, that means that you might be good at something, but you say, it wasn't that good. You're selling yourself short. You're talking yourself down at that point. You're not claiming to be as good as you really are at that point. So we get that cliche that we use in English. So when you're looking at an investment, it can be very wise to actually look at the short interest ratio, or simply called the short ratio. And there's going to be a certain percentage of the stock that a company makes available that some investors, for whatever reason, decide to short that company, where they're going to benefit if the price goes down. And there's stocks that people buy hoping it will go up, though they are long, and that's usually the higher percentage. And then there's a percentage of people who think the market, that stock will go down, and so they short the stock. And they take that and put it through a mathematical calculation, and you come up with what is called the short interest ratio. I'm not going to talk about how that's calculated. I just want to explain the concept. So typically, this is measured in terms of days to cover. Okay, what does that mean? Well, days to cover measures the expected number of days to close out all of those short positions in a stock. So if it has a 3-day day to cover short interest ratio, that means with the amount of shares based on the average volume that usually trades, it would take 3 trading days for all of those shorts to disappear. And then this gives you some kind of a number. And when you're buying a stock, you usually want to have a lot of short interest in that stock. Why? Because you have built-in buyers. If things go the wrong way, they have to come in and buy, and that's going to push prices even higher. So you want a stock that has a high short interest ratio, if you can. That shouldn't be the only reason, but it can be a reason that you use to get into a particular stock. So the higher the number or ratio, the more built-in buyers there are on the sidelines that must come in and buy or cover their short positions if prices go against them. So they have to watch these things with all those financial requirements and how things can get really out of hand really fast, where you can lose more than you invest. If the people that are in short positions, they can't just go hit the beach. They have to keep an eye on things. And they're waiting on the sidelines, and if things go desperately against them, they have to jump in and buy in order to close out their positions. So when they must act, this is then what we often call a short squeeze. They didn't want to get in and buy or close out their positions. They had to get in and buy to close out their positions, which when we see this happening, and sometimes when I do my daily videos, I'll say, yeah, the market really shot up at the end today. I think that was a short squeeze that happened because there's a lot of frenzy buying going on at this point. And people are buying not because they want to, but because they have to close out their short positions. And this can really make prices go up fast. So this is what happened this past week that just ended, to some of the hedge funds. Now, some of the hedge funds still have their short positions, where other hedge funds, they've liquidated everything. Their short positions are now gone. But that's what happened this week. So, while we're talking about this, what is a hedge fund? Hedge funds are then an alternative investment. Now, probably most of you watching this video, it's not necessarily an alternative for you. Okay, sorry to tell you, because there's pretty high requirements to get into one of these hedge funds. But they use pooled funds. They take some money from you, if you could do that. They take some money from the famous actors and actresses in Hollywood. They take it from rich people, and they put all that money together, and they try to implement different strategies to earn attractive returns. Okay, that's what a hedge fund does. I want to make you some money, man. And I got this secret way of doing it. So give me like $10 million and I'll go do it for you. That's really what a hedge fund does. So hedge funds may be very aggressively managed. Man, they're out there, they're doing anything and everything to try to make that return. They can make use of a thing called derivatives, which means it's an instrument that we trade that derives its value from something else, like an option, okay? Or credit spreads and swaps and things that that can be kind of complicated and even more difficult to understand. They also can use leverage. You use leverage now if you have a margin account. You might put $10,000 into your account, but that gives you $20,000 of buying power. You just borrowed $10,000, and that's leverage at that point. Or they can use futures contracts, which have an even greater amount of leverage attached to them. With some futures contracts, just as an example, you might put up $1,000, but the asset that you're controlling might be worth $100,000. So that's great if everything goes the way you think it will. That can be really bad if it goes the way that you hope it won't, because the losses can mount up very quickly. Some of these hedge funds, they're active in both the domestic markets inside the US or in international markets. They might invest in China or Japan or Germany or South America, or they're constantly out there looking for something to give them an edge over the rest of the market. And so they're just looking for anything to get a good return on their investment. So hedge funds are generally only accessible to what we call accredited investors, since they require less SEC regulations. There used to be no regulation on these guys. They could just go crazy. And a lot of politicians are involved in hedge funds, so that's kind of why there's not many rules there until they themselves personally get burned. Then you're going to see the rules start flying. Okay? So be aware of that. And then you might use a thing called mutual funds, which are similar in that it takes pooled money, but there's a lot more rules with mutual funds. They're more restricted in what they can do. If a mutual fund, first of all, they usually only go long. There are exceptions, but they usually only go long. And then if you have an IT mutual fund, they can't go invest in a pharmaceutical company or buy real estate in Colombia. Okay, or look at this next AI thing in China. Okay, maybe you have an IT mutual fund that only invests in American companies. They can't go outside of that. Or a hedge fund, this is what we're doing. Is it okay if I do it? Sure. They have a mandate, and they kind of tell you what they're going to do, but it usually gives them a lot of leeway to do whatever they want. It's like, I don't care. Show me the money. That's really all these investors care about. They just want the returns. They don't care how it happens. Okay. Some of the goals for hedge funds, they're designed to take advantage of certain market opportunities. For example, they can go long. If they think something is a really good stock, they may buy a lot of that stock, hoping to sell that stock in the future. They may go short, which is kind of what we're talking about today, or both at the same time, not necessarily on the same stock, although they could do that using different types of instruments. They could be long and short at the same time to kind of hedge themselves, okay, or protect themselves. But a lot of hedge funds don't practice hedging, which is kind of interesting. They got the name. All right, so hedge funds use different investment strategies and are often classified according to an investment method. Now we have these hedge fund managers who are like rock stars. If they have good returns for their people, man, they eat in the nicest restaurants, they have private planes, they get Super Bowl tickets for $1. I mean, just anything, all these different perks can happen for them. So this can be set up by the hedge fund manager, which invests, the investors then, it's like, hey, Joe has this hedge fund and he's been really good and he's a real rock star in the investment world. Okay, so I'm going to put my money into that. Well, at one time, the name Bernie Madoff had a pretty good reputation, where he made off with a whole lot of people's money. And so sometimes you're investing in a name rather than an actual investment. You like the manager. There is substantial diversity in risk and investing methods. Some of these hedge funds are pretty conservative, and they're not going to go too far off the grid as far as their strategies. Others are going to be very aggressive. So just be aware of that in the different kinds of investing that they do. It's like selling your pumpkin futures after Halloween, like Homer. Okay, some hedge funds are very conservative while others are very aggressive. Legally, hedge funds are most often set up as a private investment limited partnership. So you can't go after the manager himself. He's protected, or she is protected. That's a limited partnership. And limited means they're limited in their liability. So if they lose your money, you can't necessarily go after them very easily personally. You can go after the hedge fund, but you can't go after them necessarily, unless they break the law and end up going to jail for a long time, like some have done. And they're usually open only to a limited number of investors. Okay, we're opening for 1,000 people right now. And they require a large initial minimum investment. It could be $10 million or $2 million or something like that, just to get involved. You can see why a lot of you are probably not in these hedge funds. Investments in hedge funds are usually illiquid because they often require the investors to keep their money in the fund for a specified period of time. And one of the things that I teach in my classes is liquidity is a huge, important factor. If you want to get in, you want to get in right now. If you want to get out, you want to get out right now. You don't want to have to wait for 30 days or 60 days or 3 years before you can actually get out. Well, the hedge funds, they need your money in there. They don't want to have a run on the hedge fund where everybody's calling up really quick and trying to get all their money out at the same time, just like in It's a Wonderful Life. And then the hedge fund has $1 at the end of the day and they're all dancing to the vault. Okay, they don't want to have something like that happen. So they might say, if you give your money to us, your $10 million, you're going to have to keep it in here for 3 years before you can plan on taking it out. That buys them a little time to do what they want to do, but it also hides them for a period of time so that if something weird is going on, you might not find out about it for a while. So withdrawals may only happen at certain intervals, such as maybe every quarter, or even maybe twice a year, biannually. So some of the characteristics of these hedge funds are the SEC, the Securities and Exchange Commission, states that hedge funds are only open to qualified or accredited investors. And this is their definition of an accredited investor. You have to have an annual income of over $200,000 over the last 2 years. Now, if you went through 2020, you may not meet that requirement. And I'm not trying to be funny about that. It's a reality. It's a reality of what's going on right now. Where some people did very well, where others are really suffering right now. Or you have to have a net worth of over $1 million. And that can't include your house, where you live. It might be another house. It might be in a rental property or something like that. But you have to have a net worth of over $1 million. And then these investors are deemed suitable to handle the potential risks. Okay, I know a lot of very wealthy people that really aren't all that smart, but they would fit being an accredited investor. They might be very well versed in their own occupation, but they may not really understand the stock market. That's the interesting thing about the stock market. You have doctors, lawyers, teachers, professors, scientists who are very, very successful in that field who are just absolute failures when it comes to the stock market because it's a different game. You have to think differently. It's a different mental process that you go through in the stock market. And there's so much that's out of your control. So where you might be in a profession where you control what goes on, like as a teacher, I can control what happens. I can control what I teach, how I say it, and what I'm going to talk about, what I'm not going to talk about. In the stock market, there's a lot of things happening that nobody can really control. Then a hedge fund's investment method is only limited by its mandate. Okay, they may tell you, well, we invest in real estate in various areas of the world and stocks that are poised to go up, and we also look at stocks that are poised to go down. I mean, that's very general right there, so they could pretty much do anything they want at that point. A hedge fund can basically invest in anything. Land, real estate, there is a difference. Stocks, derivatives, these are like options and swaps, credit swaps, and all these kinds of things. If you want to learn more about that, watch the movie The Big Short or read the book. Or different currencies. There's currencies, the euro against the dollar against the Swiss franc. A lot of hedge funds take part in that. Mutual funds, which is more likely what you are involved in, it's more for the common person that doesn't, because you can open some mutual funds for $50 and it doesn't take a lot of accreditation to become part of a mutual fund. Now some do, but a lot of them don't. A mutual fund has to follow a thing called the prospectus, and that's the laws of that mutual fund. And they typically only go into long positions, and they can't go outside of what the prospectus says. Where a hedge fund, they can pretty much do whatever they want. If they tried to tell you in a way so that they don't take any blame themselves, but say, look, I told you this is what I could do, and so how come you're coming after me? Yeah. See, they always leave themselves an out. So hedge funds can often use leverage or borrowed money to get better returns. Hey, if you could buy $20,000 worth of stock and it doubles, that's a much greater return than if you bought $10,000 worth of that stock and then it doubled. Makes sense, as long as you're right, but it can really be bad if you're wrong. So the fee structure, and this is the part that'll get some people. Instead of charging an expense ratio, that's what mutual funds do. And you can go to websites and they have lists and you can compare the expensive mutual funds with the not really expensive ones. Hedge funds charge both an expense ratio and a performance fee. Typically a 2% asset management fee. And then if they make any money, they get to keep 20% of any gains. Now, some people have no problem with that. It's like, hey, if you're going to earn me some money, I'm cool if you earn money too. There's no problem there. Hedge funds can pretty much do anything as long as it's disclosed to the investors. Sometimes this is after the fact, though. So you might not hear about this until months later. Now, sometimes you might be more in the know with what's going on and actually see what's happening at that time. But sometimes you may happen way after the damage has already been done. So this can be very risky with some of these hedge funds. It's great when you're showing them the money. It's not very great when you're taking the money away. Some huge failures have involved hedge funds. We saw this a lot in the 2008 meltdown. A lot of hedge funds went belly up at that time, but other hedge funds have also produced some fantastic returns. So there are good and bad when you're looking at these things. If you're listening to this and you are in hedge funds or you're looking to get into one, I'm not here to bash them. I'm just saying they're beyond the scope of most everyday American and even non-American investors. And if you're looking at doing this, just do your research. Don't just go off of what somebody says. Dig in and find out as much as you can. It's your money on the line. Put as much effort into your investments as you are your next vacation, which you won't be able to go on because of travel restrictions. So look at this and really try to make the best decisions that you can. So why is it called a hedge fund? Hedging is the practice of attempting to reduce risk. So we have insurance, car insurance, house insurance, renter's insurance, health insurance. These cover those costs if something goes wrong. We're hedging when we buy insurance. But a lot of these hedge funds, they're not doing that necessarily. But it's just a name that they came up with and it's stuck. But it might have something completely different than actual hedging or protection. However, most hedge funds try to maximize returns. That's what they want to do. They want to be rock star hedge fund managers. So the name hedge fund is mostly traditional and does not accurately describe what most hedge funds do. We just call them that. Hedge funds can use dozens of different strategies all at the same time, and they may not even implement hedging. Just so you know, in my classes, I teach hedging so that you can protect what you already have, maybe as far as gains, or you can protect your investment. Now, it's going to bite into your returns, but at least when things go against you, you're going to break even or come close to breaking even. A lot of these hedge funds don't even do that. They're just flying money out the door, just certain that they're going to see a good return, so they don't worry about any protection or hedging. Some hedge funds are very risky and speculative. Okay, so what are some of the risks? Certain investment strategies expose hedge funds to potentially huge losses. Hedge funds typically require investors to invest money for a period of years. So even if you put your money into one of these and you want to get it out, good luck. You watch Boiler Room. There's a movie about this where you could sell whatever you wanted to sell to people, but you're not going to let them buy it back from you no matter what. And be aware of those things. So the use of leverage or borrowed money can lead to significant losses. Then the methods that work during certain periods, well, it worked a year ago. They may not work now. The markets are changing, the moods of the markets. Now, it's still buy and sell, bid, ask, but there are different things that the market becomes obsessed with and focuses on those things. And so a strategy that you implemented at one point may not be effective at another point in time. Some hedge funds have participated in illegal activities. Imagine that. Such as insider trading. Now, there's a legal kind of insider trading, and then there's an illegal kind of insider trading. We're talking about the illegal kind. Just as an example, let's say I owned a publicly traded company. And it's a pharmaceutical company, and I go golfing one day. I love to golf. And I meet you, and we're out on, you've never met me before, or maybe we are friends. Maybe you just were acquaintances, and we're out, I'm my usual under par self. Actually, I'm happy if I can shoot a bogey round, but anyway. And we're on the putting green one day, and I'm like, hey, by the way, that we got this drug, this COVID-19 vaccine, and we got the test results back, and it looks pretty good. So you might want to buy some of our stock. Now, what I just did is illegal. I shared private information with you that's not available to the public. And that is called insider trading. When you're acting on information that is not available to the public. See the movie, the first Wall Street movie. That's why at the end of the movie, Bud goes to jail. It's for insider trading. And that's what got him in trouble. And eventually Gecko gets in trouble for the same reason. Not the Geico Gecko, but Geico the investor. So the pay structure, hedge fund managers typically require a fee of 2% of their assets under management and 20% of the profits. Okay? Well, what happens if they have a losing year? Even if the hedge fund loses money, the manager will still receive 2% of the assets. Wow. Do you like that? Maybe you don't have a problem with that. That's a part of doing business. You got to spend money to make money if you want to have a good manager. Some of you might see that as very unfair. You have to decide. For example, let's say a manager oversees $1 billion. They could earn $20 million that year without doing anything. They could just keep it all in cash. And they don't lose money, they don't make money, but they're still going to earn $1 billion that year based on that 2% management fee. There have been different fee limitations known as high water marks to prevent hedge fund managers from getting paid on the same returns twice. And believe it or not, there were ways that, like double taxation. Well, this was a way for double payment. There may also be fee caps to help prevent managers from taking on excess risk. So some hedge funds implement this, others don't. So the future of hedge funds, some of these controversies that have surrounded hedge funds include insider trading, which I talked about. That has happened and people have gone to prison because of that. Tax avoidance. Some of these are set up offshore, and so they get very favorable tax rates depending on where they set these up. Some of you don't have a problem with that. Others say, I only want an American-based hedge fund. That's up to you. Management overpayment, which I kind of just alluded to, which you may not see as overpayment at all. As long as you show me the money, I don't care what you make. That may be your attitude. Others may be, wait a minute, this guy's still going to get paid even if I don't make any money this year or if I lose money? Some of you might have a problem with that. A lack of regulation, because these hedge funds have billions and billions, I feel like Carl Sagan, billions and billions of dollars, and so they carry a lot of power with them. They donate not only to the Republican Party, but to the Democratic Party too. So they have friends on both sides. So they want to be in the best shape possible for themselves, no matter who is in control of the government. That's why a lot of times you see a real disconnect between what's happening on Wall Street and what's happening in Washington, D.C., because Wall Street generally sees Washington, D.C. as little more than theater. There's just a bunch of yahoos yelling and screaming and not really doing anything. They're trying to base what they're doing on other logic that doesn't include what the politicians are doing. Now, that did change under President Trump with a lot of the tariffs and a lot of the regulations that he made go away and things like that. But they did not necessarily have a longer term impact on things. Things like Brexit, the 2016 election, the markets reacted to that, but quickly recovered and kept doing what it was doing before. So you have these short-term reactions and then the longer-term trend that usually the markets will go back to. So this has led the SEC and the Congress to consider new regulations for hedge funds. Well, some of these hedge funds have a lot of senators and representatives as friends, if not sons of presidents. Okay? And so some of these regulations might not really be all that helpful to you. It might be beneficial to others instead. Then hedge fund advertising rules. They can't go out and say, last year, man, we got 150% return. Come here. It's only a $10 million minimum. If these guys are so good, they're probably not going to have to do any advertising anyway, because word of mouth is going to spread through the elites and they're just going to magically flock to these hedge funds anyway. And then some changes have been slow because many hedge funds have a lot of money, power, and influence. Not only on one side or the other. They influence both Democrats and Republicans, no matter who's in charge or in office. So let's get into what in the world happened. Let's put all of this together. I've taken these concepts, and thank you for enduring that. I hope that's helpful, has been helpful to you. Let's put this together and see what happened. Okay, when you're looking at the markets, there's a thing called smart money. The stock market typically puts all investors into one of two categories. First of all, the smart money. This could include institutional investors, the central banks like the Fed, Bank of Japan, the European central banks, pension funds, that control Orange County, some of you remember that, or different retirement plans for your company. And believe it or not, some of these pension funds do invest in hedge funds. Did you know that? You might want to check into that. This may actually bleed through and affect some of you personally when everything is said and done. That's just speculation on my part. I don't know if that's actually true. It will depend on how things play out. And there are some really, really good financial professionals out there that are worth billions of dollars who are considered the smart money. They've spent their lives doing this and they get very good at it, and they're also very wealthy. So then you have the dumb money, and that is pretty much everybody else. And that can include some of the hedge funds. Just because they have a lot of money doesn't mean they're necessarily the smart money. So many individual investors, traders, and hedge funds may be big money, lots, show me the money, but they may not be smart money. The challenge, and this is what I do every day when I'm following things, this is the challenge that I have, is trying to determine which is which. If we see a big trade go through, is that smart money or is that just big money that's not very smart? So when you see a huge trade, it might look like the smart money is actually doing something when in actuality, it's just the dumb money doing something on a bigger scale. And then this is one thing. I don't know how this has become an interesting stigma in our culture, but I'll read a book or I'll watch an interview with somebody and they'll say, yeah, this person was a former hedge fund manager. What? Okay, if they're so good at what they do and I need to listen to what they say, how come they're a former hedge fund manager? Why aren't they still a hedge fund manager? It's like listening to a former surgeon. It's like, you're not the one that's actually going to do the operating on me. You might have been great in your day, but how's that going to help me? You might give me some useful information, but do I really know that I can trust you? Kind of a thing. And why are you former anyway? Yeah. But they use this as some kind of a selling point. Yeah, coming up, we've got an interview with a guy who was a former hedge fund manager. It's like, okay, what went wrong? How come he's not still doing that? So why did they pick GameStop to do all of this? Why is that what we're hearing about in the news right now? GameStop is an old school, they call it a brick and mortar, video game retailer that's usually located in different malls or strip malls. You might have been in a GameStop store. I've even been in them, and I don't play video games. Just happened to be there with somebody else one time. But you can see them around. But there's a problem. People don't usually go to the store to buy their video games these days. They now either download them or stream them online. So the old school way of going to the store and buying the video game is kind of becoming outdated. GameStop has had some severe financial problems over the years and was even rumored to be on the verge of bankruptcy. Okay, so it's not a really good-looking company. If you were evaluating the stock, you might decide, I don't want to invest in this. Hedge fund managers, what they do is they'll get together, and if you know about Michael Milken, it's kind of their version of the Predator's Ball, where they'll have these nice dinners, and hedge fund managers, who some of them are friends with each other, they discuss ideas. Hey, what are you doing, Charlie? I don't know, George. Okay. What may have happened, and this is pure speculation at this point. We don't know. And I'm not saying in any dogmatic way that this is what happened, but this has happened before, where hedge fund managers get together, they have one of these big dinners, and they decided together to go in and short GameStop. That might have been what happened, or something like that. Or it might have been just a few hedge funds that decided to do that, but because they have so much money, it created a real lopsided market at that point. So at the time that GameStop was available as a stock to be traded, there were 50 million shares outstanding. The only problem is GameStop has gotten to the point where there are 61 million shares that have been shorted. Okay, that's kind of strange. There's 61 million shares that have been shorted, but there's only 50 million that are available. Something's rotten in Denmark. This is called a naked short. The 11 million shares that don't exist, this produces a naked short. And there's a joke in there somewhere, but with those words. But basically, they're shorting something that doesn't exist. So a naked short, it's illegal, since the shares must be created by the company, not by the investors. And when you're a short seller, you're not an investor. You're a trader or a not that you're betraying anything. You're trading in the markets, but you're a market participant because you're really not investing at that point. You're just taking advantage of market movement. So any naked short shares must be delivered. Those 11 million shares that don't exist, they do have to exist somehow, some way. And that means whoever shorted those shares, they have to pay for that. No matter what the current price is. They may have shorted them at $4 a share. But what if GameStop goes to $1,000 a share? They have to go in and buy it at $1,000 a share and then sell it at $4 a share. You see a little problem there? It's pretty lopsided right here. This is really what happened in 1929. Not the only reason, but the 1929 stock market crash, for those of you that still get real history taught to you, not the made-up history that they're starting to teach people, there was a market crash in 1929, and this was one of the reasons that it happened. There was a whole bunch of things that came together, but this was just one reason, was there were a lot of naked shorts. This also happened in 1987 as well. And then, so what do? The government to the rescue. What FDR, who was our president at that time, did is he created the SEC. And who was the very first SEC chairman? Joseph Kennedy. Yeah. Do you think he understood the games that were going on? That's how he made a lot of the family wealth and had one son become president and another one that tried to become two that tried to become president. But things didn't turn out so well on a family scale for them. But on a monetary scale, it turned out really well. So the SEC was created by FDR and it was ran by Joseph Kennedy to stop this kind of thing from happening. Also, there's an organization called FINRA.org, which is a non-for-profit place where if you've been screwed over by a broker or a company, you can go to them. Now, I'm not talking about if you bought at 10 and it went to 5 and you want to, I'm a victim. No, it's not going to cover that. But if you bought shares that don't exist, or if there was some kind of illegal activities going on in a company, you can go to this company, this FINRA.org, to try to get some help. Where if you were screwed over, not based on market prices, but based on laws. But this was also created to help keep this from happening. Where are they at right now with this? I don't know, but they're not really necessarily doing what they said they would do. Both have been very lax with actually doing anything in this area. So what you had then, you had a lot of hedge funds that went in and shorted a bunch of games like GameStop, thinking, what could possibly go wrong? And there were a bunch of people that got together, figured out what was going on, and played the hedge funds at their own game, and to this point have won. And I just call this a populist uprising. This is where a bunch of people took it upon themselves to do something about it. So a group of individual investors, and this is really what happened here. I mean, I'm kind of summing it up right in this one paragraph. They're individual investors and traders. An investor usually holds something for longer than a year. A trader holds on to something for less than 1 year. That's how we differentiate the two. They're members of a Reddit group, a public group, by the way, that I've been to, that I can go and look at, that I could join without any problem at all. Any of you with a computer or a phone or any kind of internet access can go and look at what these guys were talking about. There was nothing secret going on here. It was way out in the open. And the name of this group on Reddit is called Wall Street Bets. They saw this. A bunch of pretty savvy individual investors figured out what was going on, and they decided to band together, and they posted, hey, who's with me on this? They weren't doing anything in secret. They were posting it out there in public. They got together, and they decided to run up the price. How did they run up the price? They buy, because they buy at the ask price. And suddenly, what a hedge fund shorted at $4 was now going to $6, $7, $8, $9, $10 a share. And that was starting to make the hedge funds kind of nervous. And what do the hedge funds have to do that have shorted the stock? What do they have to do to get out? They have to buy the stock too, which could only push it even higher. Hedge funds, a lot of them were forced to cover their short positions, another joke in there somewhere, which drove prices even higher. So the hedge funds that did not cover are now carrying a very large unrealized loss. When you complete both sides of a transaction, whether you lose or win, that's realized. If you have a position, like you own some stock and you haven't sold it, but you're showing a profit, that's unrealized as a profit. Or if you have a loss, that's an unrealized loss at that point. So everything that these Wall Street Bets guys did was right out in the open. Anybody had access to that information. I'm not even a member of Reddit, and I was reading the board the other day. So you don't even have to have an account to look at all this stuff. But a lot of times these hedge fund managers, they'll do this secretly. They don't tell you what's going on. They gang up together and do things that benefits them, but can hurt everybody else. Okay? Well, these guys on Reddit decided to play them at their own game. So the individuals found a vulnerability. A lot of hedge funds had shorted GameStop and other stocks. They banded together and decided to take advantage of it. Attempts were made to shut down the Wall Street Bets server. That's what they tried to do, but that only lasted for about 1 hour. And of course, since everything a white person says these days is considered hate speech, they shut them down because there was some kind of hate, according to the Reddit guidelines. Well, that only lasted for about 1 hour before they turned the server back on because there was such an outcry over that. But yeah, okay. And this is the hero, guys. It looks pretty heroic to me. Keith Gill, I think is his name. He's the guy that kind of came up with this idea and then just put it out there on Reddit. A bunch of other people thought it was a good idea. They decided to band together and do it. And now this guy's a rock star. Doesn't he look like a rock star? Yeah, okay. So let's look at Thursday, January 28th and what happened there. There's no need to fear. Robin Hood is here. What happened was, and I'll get back to Robinhood anyway, that's a newer retail brokerage firm where you can participate with not much money and they don't charge any commissions. And so a lot of these individual traders and investors, they're using Robinhood. Well, even they got into the act here at one point. But on Thursday, GME, that's the symbol for GameStop, it climbed to $483 per share. That was the ultimate high so far as of the end of January 2021. Now, some people are saying, yeah, it's going to go to 1,000, baby. Or other people are saying that it's going to go to 0. We'll have to see. But it's interesting to watch. So some brokerage firms stopped allowing trades by traders where they could buy GameStop, and there were also other stocks involved. All right? Some of the brokerage firms that actually restricted trading are, and some of you may have accounts with these companies, Robinhood, and take from the rich, give to the poor. They restricted trading on Thursday. And they're like, but that's the whole purpose I went with you guys. And now you're restricting me? You're doing something that is now hurting me as an individual and benefiting the hedge funds? You're not very Robin Hoodish to me. But after a lot of backlash, they relented on Friday. And then a thing called Webull. Some of you may have accounts with them. E-Trade. I have an account with E-Trade. This was my very first account many years ago. They restricted trading. Interactive Brokers. I also have an account with them, and I've used them heavily over the years. And then other companies like Charles Schwab and TD Ameritrade, they didn't stop all trading, but they restricted certain types of strategies like buying options, which that was happening really heavily too. And I'm not going to explain what those are now. I have a whole class that talks about that. But there were some restrictions there as well. So on Thursday, if you had a Robinhood account or a Webull or E-Trade or Interactive Brokers account, the only thing you could do was either hold on to any stock that you already had because you were buying to get in, or you could sell. That's all you could do. That doesn't sound very American, does it? Freedom? Freedom! No. You were restricted. Capitalism stopped that day. So if you wanted to get in and do something, you were not allowed to do it. And some people have a real issue with that. And that's why I'm taking the time to explain this, for you to decide if you have an issue with that or not. This caused an outcry from account holders. Wait a minute, I set up an account with you because you said I could do these things and I'm the little guy and you're trying to give me the same advantages that the big guys have, and now something happens and now you're restricting me? I don't think so. And a lot of people started to complain about this, and then Robinhood, at least Robinhood, I don't know about the other companies, they decided to relax those restrictions. Then, some members of Congress called for hearings. Oh yeah, gotta have a hearing. Congress will get to the bottom. Well, it was kind of strange when you had AOC and Ted Cruz actually agreeing with each other. Yeah. Now, AOC has probably retracted that by now. I really don't know, because she actually said something that was intelligent, and she can't do that. So she's probably changed her view at some point, and even Ted Cruz for that matter. But there's going to be people in Congress that are going to try to tell you what's going on, and they're going to try to fix the problem when they don't even understand it themselves. And they're going to come up with things, and they're going to tell you things that may not even deal with the situation. So just be aware of that as well. So let's look at Friday, the 29th. As of the market close on Friday, January 29th, 2021, it's estimated that hedge funds have lost about $20 billion during the month of January. Okay, this includes realized and unrealized positions. Realized positions that were closed, unrealized positions that are still open. So just in the last week, some big well-known hedge funds have lost anywhere from 15% to 33% in 1 week. Some of these guys are rock stars if they make 15 to 30% a year of positive returns. Well, now they're losing this amount in 1 week. So there's a lot of wealthy people that are going to be pretty ticked off about this. So let's look at a chart. This goes back all the way to 2002 when GameStop, and that's really the only stock that I'm focusing on right now, when GameStop started to trade and came open at around $8, $9 a share, $6, $7 a share. And I'm going to use a mouse here, and I'm going to come over. It's hard for me to move this mouse, but this is where when it first went public, and it started to trade. And then during the early 2000s, after 9/11 and all that happened, GameStop had a pretty good rise. Well, then we got into 2007 and into 2008, and things started to go south with everything else, and GameStop really suffered. Then it started to get a little bit better in 2012, 2013, made it all the way back. You could say this is a double top. It got all the way back up to its all-time high, roughly, at about $41, $42 a share. Then it went down and sideways for a while. And then as you've seen the growth of streaming and online gaming and things like that, GameStop has really gone down. And when a lot of these hedge funds got together, it was $4, $5, $6 a share, because they started to do this last spring and summer, when they started to short this. And but then you can see near the end, this finishes right on the last day of trading in 2020. It started to shoot up back in December. So this hasn't happened overnight. This has been building for a period of time. And then here, just to show you, and I looked at this, and this chart was so funny because this goes all back 10 years. Well, all this little bumping around doesn't really mean anything until you just see what happened this past week. And it got all the way up to $483 for one share. And it closed at about $325 per share on Friday. So, yeah. Now, just to show you something else, this is an intraday chart. And this goes back a little over a week, where you can see prices, and I'm trying to use this mouse and it's just not cooperating here. But each one of these bars is 10 minutes. And I use a thing called candlesticks. If it's green, that means that 10 minutes closed positive. If it's red, that means that 10-minute period of time closed down or negative. But you can see that things really started to go up in the early part of the week. The latter part of last week on the 22nd, and then really started to take off. This is when I started to hear about it, was over the weekend, and then I started to watch it on Monday the 25th, and then it really started to shoot up. And then this on Wednesday is when things really started to get exciting, on the 27th, where it really shot up higher, and then everything hit the fan on Thursday. And this is when it got all the way up to $483 per share. This is when Robinhood and the other brokerage companies came in. They halted the ability to buy more. And you can see things just tanked and then just kind of bounced around to the end. Then they stopped those restrictions on Friday. We saw a gap up with the stock, and it kind of went sideways, went down a little bit. And we didn't see a lot of different action, comparatively speaking, on that day, where it closed right at around 325. What's going to happen next? I have no clue. I don't follow this stock. I'm just following what's already happened. Okay, so let's look then at some of the different stocks that are actually involved here, and I just put them all up here on the screen. Some of these I'm not even mentioning, and the list is even longer than this, but these are probably more household names and things that maybe you've used, or companies that were real darlings at one time, but now because of things changing, they've fallen out of favor. And of course, Blockbuster. How many of you went to Blockbuster to get your movies back in the day? That's where I went. Costs, and then of course GameStop, Express, AMC. Yeah, how movie theaters doing these days? I don't want to laugh because it's hurting lots of people. But that's just the reality of what's going on right now. New Concept Energy, BlackBerry. Wow, they were like the darling stock at one point. And now they're not doing very well. Bed Bath & Beyond. A lot of the retail stocks have really been hit hard because of the whole COVID-19 debacle that has happened. But you can see these are their returns just for January. And some of these don't see these kinds of returns for their whole life. But here, just in 1 month, you can see how they skyrocketed around. So there is more than just GameStop with this. It's just GameStop is getting most of the press these days. So where do we go from here? What happens? As I record this, it's the weekend. The markets are closed. Everybody's getting a couple of days to fall back and regroup. what is likely to happen from here? First of all, I don't know. I can just kind of piece things together and give you some scenarios of things that you really should kind of watch out for as we're going along here. So the government, yes, they're always there to help us, aren't they? Along with their friends, the media, they're likely to step in and do something in the name of helping the little guy. See, we live in the age of being a victim now, and nobody wants to take personal responsibility for anything anymore. We want to say, I was wronged, I was cheated. And unfortunately, that comes from the top down in a lot of American society these days. But nobody really wants to say, okay, I messed up. This was my fault. I'm not a victim. I just made a bad decision. Well, we don't live in that kind of an America right now. And we haven't for a long time. And so people are always crying foul about something. And then so the government comes in and to save the day. But when they try to save the day, what usually happens pretty much all the time is that you have to give away some of your freedom for the help that they want to give you. But they may come along and say, well, we have to protect these individual investors from themselves because they don't know what's going on and they're just going to make all these stupid decisions. And so we have to create all these rules. That's what they might say to you. Don't ever go by what anybody says, even what I say. Anything you hear on the news, anything you hear from a politician, don't believe any of it unless it can be backed up with multiple reliable sources. That's what I do. And don't base things on emotion. Try to base things on good, solid facts. Because we've been fed a lot of garbage for a long time. And we need to be able to separate the emotions from what the true facts really are. And so they may come in and say, well, I'm protecting you. I want unity. I want everybody to love each other. They're going to tell you that. But now we have to look at what they really do. Not just what they say, but what they do. So in reality, they might go ahead and bail out the big guys in this case. They may tell you that they're helping you, but in reality, they may be helping them. Look back to the meltdown, 2008. A lot of people that got really hurt during that time, the government came in and said, we will help you, but they bailed out the people that caused the problem. That's really what happened in most instances. Now, some of you may disagree with that, but based on what I've seen and what I've researched over the years about that time, that's really what happened. And so the government has a tendency to do those kinds of things anyway, so we have to be on the lookout to see if they're going to do that again. Then the market is correcting what the government said it would fix. That's really what's going on here. Some individuals, some people that are probably in their 20s, got together, decided to band with each other. Everybody kind of understood what was going on, thinking maybe we can really do something here. And the government was supposed to have already fixed this. That's what the SEC and FINRA were supposed to do. But they created the rules, but they didn't enforce them. And so some individuals came along and said, okay, well, we're going to take matters into our own hands, and let's see what happens after that. Okay? So this was supposed to have already been fixed. And there are rules to fix it. They just have to be enforced. So as of right now, as the minute that I'm recording this is the weekend between, tomorrow is February 1st, and the markets will be open again. This is that weekend time when things are shut down, and as of right now, things seem to be okay. But we're in the middle of this still. We don't know what the longer term ramifications are going to be. So the excuse may be that the government will say that they tried to stop it when we shut down that server on Thursday, or that was Wednesday, and we told those brokerage firms to not let them trade. See, they're going to try to create a victim, and then they're going to try to create a fall guy. They're going to try to pinpoint the blame on things. And this has happened before too, where things that have happened like flash crashes and the meltdowns and the tech bubble and the savings and loan crisis, if some of you remember that, they always try to point to somebody to blame them for it. And then that becomes the logic of what happens. It may not be the reality, but it becomes the logic that is used. So, but they may come back and say, hey, we tried to shut down that server. We tried to get Robinhood to stop letting people execute their trades. And the people said, open it back up. And so now they'll come back and with an I told you so kind of an attitude. So will the government bail out the hedge funds? Oh, this is going to be interesting because a lot of these government people, they're in these hedge funds. They have lots of money tied up into them. You know, it used to be when you did a civil service job, civil servant type job, you generally weren't paid all that much. And you just had the gratification that you were helping your country, you were helping society, you were helping people. Well, now, a lot of these senators and Congress people and different politicians all over the country, they get into office and suddenly they're multi-millionaires. How's that happen? They certainly aren't doing it on their salary. So, do you see a little hypocrisy going on right now? Okay, but we'll have to see. If some of these big, and I'm not even naming any of these hedge funds, I don't really care myself. But some of you do, because you might either directly or indirectly be involved in some of these hedge funds. And so you might like that these hedge funds are going to get bailed out. Your retirement might be affected in some way by that. So it can mean different things to different people as far as your perspective of how it affects you personally. So would the government bail out these individuals, though, if the things were reversed? Let's say these guys on Reddit get screwed over and they end up losing everything and they're homeless and they have to take their Ferrari back that they earned last week. If the situation was reversed, do you think the government would step in and help and just give them money? Well, they might step in and help, but you're going to have to give them something back, which is usually exchanging your freedoms for their help. So we'll have to see how that goes. But no, if I'm in the markets and I make a bad decision and an investment doesn't work out the way I want it to, that's on me. I don't want to go blaming somebody else. I have to take responsibility for that. And we've lost that in America, taking personal responsibility. It's up to us to do it as each individual person. That's where I come out. So, will the little people be blamed for the mistakes of the big guys? Look at the tech bubble. Look at 2008, the housing meltdown. Eventually, all of that was blamed on the little people, even though we can clearly see that that was not the problem. So, and then will social media end up censoring this too? They've already restricted what we can say. They've already restricted our First Amendment rights to talk about anything that might have to do with politics or how you think or feel or what your faith might be or what your faith may not be. They've restricted our ability to do that. Are they going to start censoring this too? We'll have to see. Is that Reddit public room going to be taken down and restricted? You know, we've heard a lot about Twitter, we've heard a lot about Facebook, and even on YouTube and things like that. Well, is Reddit going to get involved in this as well? I don't know much about Reddit. I don't even have an account at Reddit. But now I go there because something is happening and it looks kind of interesting to follow. So is this a contagion? Okay, you might not know. What in the world is a contagion? Just think COVID-19 is a contagion. It starts in one place, Wuhan, China, and then just spreads. At first, it just affects a few people, and then those people infect other people, and it grows and grows and grows until now we have a worldwide pandemic. Well, is the same type of thing going to happen in the financial markets? So a contagion is the spread of some kind of a financial crisis. In the year 2000, it was a tech bubble. In 2008, it was a housing crisis. There was a little bit of a contagion in the gold market in 2012. Now, and there's been others as well. Now, is this something that is going to start as a small problem and then become a big problem that'll affect the whole stock market, the larger, the U.S. economy, the whole country, or even spread internationally? We don't know at this point, but we can watch and we can prepare and we can be ready for we can come up with a plan to come up with what we're going to do if this is the start of something that grows bigger. So far, as of right now, this event has not produced a contagion, but the story's not over yet. This is still being played out. Now, usually what happens, if you go on YouTube, you're not just going to find my video. You're going to find all kinds of people that are trying to explain this to you. So with so much attention, it may be that things get back under control before things get really bad and produce a larger crisis. Usually what happens is these kinds of things tend to creep up on the uninformed. Now, if you're following this and you see what's happening, you can then act accordingly. But if you don't really pay attention, it's like, how'd that happen? I didn't even hear of GameStop a week ago, and now it's in the news all over the place. So we have to be a little worried about that. So most hear about a contagion after it happens, unless you're paying attention each day. And I do that. I follow what's going on. When the market's closed, when it's open, I'm watching everything. I'm reading. I'm constantly trying to keep myself informed as to what's happening. So what I tell you, the people watching this video, I'll pay close attention to what's happening. And as I share things that I deem are worth sharing, I'll share them with you. I'll do another video like this. I have no problem with that. And if any of you think that I made a mistake in any of this video, let me know. You know, I'm just trying to kind of figure this out too as things go along. So there is a better way though. How can you yourself, how can you take this video that you've just spent all this time watching, how can you take this and use it for yourself? Well, let's see. What can you learn from this mess? First, being a short seller in the stock market is not something that anyone, including the guys on Reddit, they're taking big risks. Now, this time it worked out for them, but this coming week, we don't know what's going to happen. We don't know how things are going to play out. So it's not something that anyone should do without a serious understanding of the concept, understanding what you're doing, and then the risks. What if things don't go the way you thought they would go? And I don't teach people in my classes how to be short sellers. I don't do that. It's too risky. The financial requirements are too much, and there's too much risk. So I want people to understand the concept, but I don't teach people how to actually do it. However, I do teach people how to take advantage of market prices as they fall. There are safer instruments available that allow you to take advantage of the market going up or down or sideways. And that's what I teach, are people how to do that. There are vehicles that are available that allow investors and traders, remember, less than a year, over a year, to make profits when the market goes down, and without incurring a lot of the risks that short sellers must face. Yeah, you can still lose if you don't do it right, or if you don't hedge yourself. There is still a possibility, but you're not going to lose your house. You're not going to lose your company. You're not going to lose more than you invest. Those are the kinds of things that I share with people. So, an educational offering that I'm making to you. I have over 25 years of studying and analyzing the stock market. This is what I do. It's my passion. And yes, I'm an individual investor as well. But number one, I'm an educator. And I want to take what I've learned and then teach these things to other people. I'm willing to help educate anyone who's willing to learn. That's the key. I'm not going to tell you what to do. I'm going to teach you things so that you can think for yourself. So, and I'm willing to work with anybody, but not everybody, who is willing to learn about the stock market. So if you have that really a deep desire to do that, I might be able to help you. If you want to be told what to do, I won't help you. I realize that what I have shared with you in this video, it's not really new to me. I've understood this for quite a while. But what you've been watching here, this may be brand new to you. So it can take a little bit of time for this to kind of, it's like things that you're not really all that aware of. So it can take some time before you have that aha moment. So teaching people about this topic is what I do. I have a business, or I'm an educational business where I teach people about these things, and then I update what they're learning each day or week, depending on what kind of an investor you are, and then I show you these things as they're unfolding. So if I can help you, please contact me. I would love to hear from you. Even if you hated this, even if you disagreed with either a few things that I said, one thing that I said, or everything that I said, I don't care. I'm confident in who I am. Doesn't bother me. Okay? But feel free to contact me. Anything that's handled, thrown my way in a respectful manner will be treated with respect. Anything that is not handled or comes to me in a non-respectful way, I just ignore that. So just know that's how I roll, baby. Okay, I'm not a licensed broker. I will not trade for you. I will not tell you what to do. I'm not a financial manager of any kind, and I never want to be. I am an educator. Also, in my whole program, I don't have any sponsors. I don't have any advertisements. In some point in the future, I might be an affiliate for some of the products and books that I read or some of the things that I use. But I only benefit from that if you end up buying it yourself. But nobody tells me what to do. I don't have any sponsors at all. I have total freedom to do what I want, and I plan on exercising that freedom. So I'm available by email. I have a Skype account. If you're on Facebook, I have Messenger or Zoom. Any one of those, you want to set up a time and talk to me, let's talk. Let's have a good time. Okay, this is my email address, john@spxinvesting.com. At the time I record this, I do have a website, but it's being rebuilt right now. I'm rebuilding it, and you won't get anything. You'll just get an error message or some kind of, it's down right now because I'm totally rebuilding it from the ground up. So, but there is, if you're on Facebook, a public Facebook group that I've created and that I administer that anybody can join as long as you're nice, okay? Invitations will be sent out to you. Just send me a friend request or something on Facebook. It's John Clay from Tacoma, Washington. There's a lot of John Clays. Or send me an email and I can tell me your Facebook information and I'll send you a request. As an added bonus, for those of you that have endured this video and you want to watch even more of me talking, there is a free workshop that I can give to you as a gift. Please click on the link right below this video and you can watch my free workshop that provides insights that you may overlook. And I don't just talk about the stock market. I talk about a lot of different things. Athletics, your professional life, music, and I do throw in some things about the stock market, but not concepts like what you saw here. They're more just ideas and things to hopefully help you to think a little bit differently. And the hope is with this workshop is to have you ask questions of yourself and then possibly consider some new alternatives. So it's less than an hour. It's shorter than this video. So if you want to watch any more, please feel free to click on that. So I want to thank you for taking the time to watch this video. And yes, down in the corner, I teach English online, and most of my students are Chinese students. And yes, that's one of my adorable students right there. I got the permission from her parents to be able to use this picture. So this kind of gives you an idea of some of the other things that I do. So I appreciate you taking the time to watch this video. If you desire, please click the like or dislike button below. If you've gotten all the way to this part, you probably liked it. liked the video. If you didn't, you probably stopped way before this. And please leave me any comments. That will really help me in having this video be discovered a lot easier on YouTube. And also consider subscribing to this channel and then clicking on the bell to be notified anytime I post any new videos. I have a lot of live broadcasts that I do, as well as pre-recorded videos like this. The one drawback is this is a one-way forum when I do videos like this. I have to pretend to know if you like this or if you're interested in what I'm talking about, but I don't really know. I can't look at your eyes. I can't have you ask a question. So I hope I've hit things in the right way. And there's nobody to laugh at my stupid jokes either. So that's kind of a drawback, and I'm not used to that as much, even though I've been online teaching for quite a while now. So thank you again, and I hope everybody has a really good day, and contact me if you have any questions or any feedback, either positive or negative, and take care. And I will hopefully talk to you again soon. Bye-bye.